So you've heard about RAs, aka retirement annuities, and you know that they are highly recommended by financial advisors to invest in order to make sure that you can retire comfortably. But is a RA really a good option? What exactly is lurking underneath the glamorous tax savings that gets promoted everywhere? Hey guys, my name is Peter. I'm a vet who loves to talk about all things personal finance. Now, retirement annuities in South Africa have quickly become one of the most controversial topics, especially amongst more experienced investors. So in today's video, I am going to break open and analyze exactly what the benefits and the concerns of a RA are, and at the end, I will give you my personal verdict and recommendation on whether or not you should consider investing in an RA based on my own conclusion. So if you want to start investing in an RA, or if you are already invested in one but you are unsure if you should continue to do so, then make sure to watch this video all the way to the end so that you can make your own unbiased, informed decision. And by the way, when I talk about retirement annuities in this video, I'm also talking about pension and provident funds, as they are all essentially the same thing. Okay, so let's clap it. Alright, so because I see myself as a rather strong optimist, let's start off with the benefits of investing in an RA. Everything good about an RA can basically be summed up as the tax savings that you will receive. Firstly, all of your contributions to a RA is tax deductible. That means that whatever amount you put into your RA gets deducted from your gross income, and then only the balance will be taxed. So essentially, this will help to lower your tax liability, and you will in turn receive a tax refund from SARS, that is free money that can be used to pump back into your investments to help accelerate your wealth. If you want to see a calculation of exactly how much you can save with this method, then go check out this video. But just to show you how powerful this actually is, let me quickly explain. For every R1 that you invest in an RA, SARS will allow as a deduction an amount equal to your current marginal tax rate, which is between 18 and 45% according to the SARS income tax brackets. So let's say that you fall into the 31% marginal tax bracket. This means that you will receive 31 cents as a deduction from SARS for every R1 that you invest in your RA. This translates to you only paying 69 cents for every R1 invested, which is an immediate, guaranteed, effective return on investment of 31%. The higher your marginal tax bracket is, the bigger your guaranteed return will be, as shown in this table. Cool, eh? Okay, so the second tax saving that you will receive is on the growth of your investments inside the RA. All of your investments will grow free of capital gains tax, dividend withholding tax, and interest tax. These tax savings on your investments growth can have a massive compounding effect on your returns and is one of the most powerful tools in the investment world. In fact, Albert Einstein called compounding interest to be the 8th wonder of the world, and he was a pretty smart dude, so we should be listening to him, right? Okay, so I'm sure you were all familiar with these two benefits, but there are even more tax savings that not many people know about with regards to RAs. The third place where you will save tax is when you one day retire, which is currently above the age of 55, and you start to withdraw from your retirement annuity. The first 500,000 Rand that you take out will also be completely tax-free, whereafter you will be taxed on a sliding scale. The fourth tax saving that you'll receive is when you die. What? So when we die, and die we shall, all of our assets, which include our house, investments, insurance, car, savings, basically everything that we own, will get included into our estate, and this will get taxed on a sliding scale starting from 20%. Yes, the government is so greedy that they will even go as far as taxing dead people. And this is not even all. When your beneficiaries want to benefit from your estate payout, they will need to appoint an executor who will usually charge around 3.5% excluding VAT of the total value of your estate. So let's say you die with a net worth of 1 million Rand. Of this 1 million Rand, 200,000 Rand will go to the government in the form of a state duty tax, and 40,250 Rand will go to the executor, leaving only a balance of 759,750 Rand that will actually go to your beneficiaries. I know, that really sucks. But now with a RA, all your investments inside the RA do not form part of your estate, and therefore no estate duty tax is payable, and consequently also no executive fees either. Now the next one is quite interesting. In our working career, we tend to earn more each and every year as our skills improve and we become more valuable. This means that we should theoretically earn the most the year just before we retire. But once we retire, we won't have as many expenses anymore, which means we won't have to earn as much in order to sustain our lifestyle. We will still be taxed on the income we receive in the form of pension, but this basically means that the lower taxable pension income combined with the larger tax rebates that you will receive after the age of 65 and 75 will result in you paying a lower average tax rate after retirement. Thus, while you contribute towards retirement, you save tax at a higher tax rate, and when you retire, you pay tax at a lower tax rate. In effect, this difference is another added guaranteed return on tax savings after retirement. Now, I am by no means a tax expert, and these calculations can become quite complicated, but I will give you an example I found on this article from MoneyWeb. If you earn 50,000 Rand per month, your average tax rate after rebates is around 23.79%. Now, when you retire at age 65, you get the first 500,000 Rand tax-free, as mentioned earlier, which is a guaranteed return on investment on the first 500,000 Rand of 23.79%. If you have saved enough for retirement and you are able to receive 70% of your last salary as pension every month, your average tax rate reduces to 17.07%, resulting in a permanent tax saving of at least 5.28%. And if you are older than 75, this gets bumped up to a permanent tax saving of 5.97% due to the higher tax rebates that you will receive. And then lastly, not really a form of tax savings, but still important to know, all of your investments and investment returns inside a RA are protected from your creditors. This means that if life one day goes completely south for you and you get swallowed by debt, your creditors can take your house, your car, and heck, even the clothes on your body in order to settle your outstanding debt, but they cannot, by law, touch any of your investments inside your RA. Now, I know none of us are planning on reaching this point, and if you subscribe to my channel and watch my videos every week, you will hopefully be well equipped enough to prevent this from happening. But life can happen, and we cannot always predict what tragedies may come our way. So it is at least nice to know that we will still have some sort of provision for retirement, even if the world seems to be burning down around us. Okay, so this sounds great and all, but what is the catch? Well, there are basically four main concerns when it comes to RAs. The first one is the potentially limited growth in your investments. All RAs are regulated by Regulation 28 of the Pension Funds Act. This means that they can only have a maximum exposure of 75% to shares, 25% to property, and 30% to offshore assets. Now, seeing that the RA is a long-term investment, conventional wisdom tells us that we need to go as aggressive as possible with our asset allocation in order to get the maximum returns, because, you know, higher risk usually translates to higher returns. So over a long period, growth assets like shares and property tend to outperform income producing assets like bonds and cash. So ideally, for a long-term investment, you would want to have as much exposure to shares and property, with some people even recommending 100% exposure to shares if you are still very young. Also, the South African stock market's returns are quite pale in comparison to what you can get in the offshore market, at least for the past decade or so, meaning that you would also ideally want to have a high exposure to offshore assets when invested for the long term. Now, the RA regulation prevents us from achieving this, as even the most aggressive RA funds are still seen as relatively conservative, as most of them have a high exposure to bonds and cash in order to try and bring down the volatility of the funds. So having an RA with only 65% exposure to shares, 10% exposure to property, 15% to bonds, and 10% to cash will most likely underperform a fund that has 90% exposure to shares and 10% to property in the long run. Likewise, a RA which only has offshore exposure of 25% will most likely also underperform a fund that has offshore exposure of at least 50%. Now, I'm not saying that this will definitely happen, as no one can actually predict the market, but based on past data and just logic, common sense, this is a concern that many have when it comes to RAs, as they feel that their growth may be stunted by this regulation. The second concern that people have is how much of an influence the SA government will have on these RAs. Let's be honest, our government is far from competent to manage anything, and coupling incompetence with corruption can create a massively negative attitude in investors' minds about the future. The government controls the country's regulations, and they can therefore theoretically also change Regulation 28 any way that will benefit them the most. For example, they can decide that a portion of your RA needs to be invested in prescribed assets such as state-owned enterprises. And I guess I don't even have to tell you what a disgrace Eskom and SAA have become under their rule. So, as investors who want to achieve maximal returns in order to provide for ourselves and our families in the future, we want to invest our hard-earned money in good companies that have the potential to grow and be prosperous, not ones that are run into the ground and stolen naked by corrupt policies. Now, I know I sound like I have a lot of beef with the SA government, and in many areas I do, but these are the facts and things that you need to be aware of when making these important financial decisions. The third problem is the costs. Seeing that many of the old school RAs are provided by insurance companies, the costs on these things have been horrendously expensive. Expensive fees will compound, and just like compound interest can work in your favor, compound fees can really stunt your growth. So paying an effective annual cost of 3% every year is just ridiculous, as this means that your fund needs to perform at least 2% better consistently just to match the returns of a passive fund that costs 1%. But luckily, many more options have been made available to investors lately, and you can still invest in a passively managed RA that is dirt cheap. And if you want to know what the best and cheapest options in South Africa are, then make sure to go check out this video. And then lastly, not really a concern, but more a clarification, you will still need to pay tax on the income you eventually receive from your RA during retirement in the form of a living annuity. You will still save taxes as explained earlier, but it is important to know that an RA is not completely tax-free as with a tax-free savings account. You will still have to pay what is called deferred tax, meaning you save tax now in order to pay tax later, albeit at a lower tax rate. Okay, Peter, so just give it to me straight. Should I invest in an RA or not? Well, I can tell you what you need to do with your dog, as I am a licensed veterinarian. But I cannot tell you what you need to do with your finances, as I am not a licensed financial advisor. But I can tell you what I will do, and you can make of that what you want. For me, the massive tax savings is undeniable. Being in one of the highest tax countries in the world, we really do get hammered on tax. For some of us, taxes will be our single biggest expense. So finding ways to try and bring down our tax liability is definitely a smart financial move, and an RA does provide you with many of the best and most effective ways to do so. I really try to keep an optimistic outlook on our country and do want to believe that the government won't dig their dirty little fingers into the retirement pots of the few people in the country who actually tries to do the right thing to plan for their retirement. So all in all, seeing that the tax savings becomes really powerful in the high tax brackets, I will only consider investing in an RA after I reach the 31% tax bracket. This is also because there is no tax savings differential at retirement if your retirement income is in a higher tax bracket than what your tax bracket is when you make your contribution. Investing in an RA when your marginal tax rate is 18% and then withdrawing pension at a marginal tax rate of 26% won't make any sense. Hence why the 31% marginal tax bracket will be more logical to me, as I don't think that I will need more in retirement than what falls into this tax bracket or anything above it. I will always prioritize filling up my tax-free savings account first, as I believe that it is the superior investment product when compared with an RA, as it allows more freedom to invest where and in what I want. And many other South African investors share the same sentiment. Whatever I have left over after my tax-free savings account contributions, I will split equally between my RA and direct offshore investments, where I will convert my rands to US dollars and then invest in Irish domiciled ETFs. So that is what I will do. So yeah, I believe a RA is definitely something to consider, as it can become very powerful if you are a very high income earner. But just remember, a RA is just one aspect that should form part of your overall investment strategy. So if you feel like it has too low exposure to shares or offshore markets, then use your tax-free savings account or discretionary investments to offset this by increasing their exposure to these high growth asset areas. There's a really cool tool that you can use on the My Money Tree website to see if it will make sense financially for you to invest in an RA based on your own personal situation. So I will link to it down in the description if you want to check it out. So what do you think? Would you still invest in an RA? Let me know down in the comments. And if you found this video helpful, then please consider hitting a like so that this video can be shown to more people. Thank you and have a lucky day. Cheers.